You're familiar with these before. Go ahead, as I said, I went ahead and put an E in all these spots to give me a head start so I don't have to futz with them later on. All right, so A, recorded $200 worth of depreciation expense. Well, when you record depreciation expense, you debit depreciation expense, credit accumulated depreciation. Well, depreciation expense, or expenses in general, decrease your net income. So we decrease net income by $200. And then our accumulated depreciation, which is a contra asset account, also depreciates our assets. Let's look at land. We sold land that originally cost $26,000 for $22,800 cash. Well, you can see there's a problem here, right? We paid $26,000, we're only getting $22,800. We're going to have a loss on sale of that particular asset, which is going to decrease our net income by $3,200. We are going to increase our cash by the $22,800, but we will also decrease our land by the $26,000 that we paid for it. Let's look here. C, recorded $136,000 payment for the cost of developing and registering a patent. Well, anytime we pay for anything, our assets are going to go down, specifically cash. So cash will go down by $136,000. And in exchange for that, we're going to get a patent, which is an asset. It's an intangible asset. You can't touch it, but it has value. So assets, patents in this case will go up. Let's look at D. We recognize periodic amortization for the patent in Part C, assuming the maximum statutory life. Okay, so the patent would have a maximum 20-year useful life. That's how long you are granted protection under a patent for, 20 years. So if you take the $136,000 and you divide that by 20 years, you're going to get $6,800. So we are going to decrease our patent by $2,600. I'm sorry, $6,800. And our amortization expense is also going to increase, but that again will decrease ultimately our net income. So we'll have a negative effect on our owner's equity there. So we would debit amortization expense and credit the patent. How about E, capitalize $6,400 of cash expenditures made to extend the useful life of production equipment. So when they say capitalize $6,400, I mean, since we've increased the useful life, we have to add that to the cost of the asset, and that will become a depreciable expense now. So we will have to depreciate that $6,400. So in this case, our cash, again, anytime we pay cash, cash is credited, cash will go down, that reduces our assets. And our equipment will go up now by $6,400. We would debit that. How about F? Expense $3,600 of cash expenditures incurred for routine maintenance equipment. In this case, we get to expense it. So when we pay for that, $3,600, cash goes down, which is an asset. Expenses go up by $3,600, but remember that ultimately decreases our net income or our equity. So we will have maintenance expense there minus $36. Remember the whole goal here, we have to keep this equation in balance. Assets equal liabilities plus net income. So even if you didn't know what to do with maintenance expense, if we have a decrease on the asset side, that means we need a decrease on the opposite side or an increase on the asset side. Almost done here. G, sold a used machine for $18,000 cash. The machine originally cost $60,000 and had been depreciated for the first 2 years of its useful life using the double declining balance method. It says you must compute the balance of accumulated depreciation before you can record the sale. Well, I'm just going to peek here to see if it gave us the accumulated depreciation, which they do, $38,400. So you really don't have to calculate it. The way we would calculate that, remember, is to take the book value times 1 over the useful life times 2. And that would be your annual depreciation expense. So if you do that calculation, you would find out in year 1, we would take 60,000 times 1 over 5, which is 20%, times 2, so 40%. 60,000 times 40% means $24,000 worth of depreciation expense in year 1. Then we need to recalculate that book value, which is cost minus accumulated depreciation. So the cost of $60,000 minus the $24,000 in accumulated depreciation would be a year 2 book value of $36,000. Multiply that times the 1/5 or 20% times 2, which is 40%. Take that 36,000 times 40% and you get $14,400 worth of depreciation expense in year 2. So a total depreciation expense or accumulated depreciation over those 2 years of $38,400. Now when we sell an asset, we have to get rid of the cost of that asset on our books. So we will have to credit the machine for what we paid for, which was $60,000, and that's going to be a decrease here. We are also going to receive cash. It says $18,000 in cash. Actually, let me back up. There we go. So credit the machine. We would debit cash for the amount received. We would also debit our accumulated depreciation. So that accumulated depreciation is actually going to increase our assets because we're removing that. And then, let's see, what else do we have? Anything? Oh, we have the potential loss or gain on sale. So what we would have to do, and if I had a little pencil, I'd write it off to the side for you. So we debit cash for $18,000. Go ahead and debit our accumulated depreciation for $38,400, and then credit machine for $60,000. And then you have to figure out, do your debits greater than your credits and vice versa? They have to equal. In this case, our debits are less than our credits, so we're actually going to have a loss on sale of equipment for the difference between the two. So if we come up here, we'll see $3,600, and that should reduce our net income, that loss on sale. Okay, the very last thing that we have here is we purchased a business for $640,000 cash. So anytime we pay cash, we say we credit cash, where we reduce our assets by $640,000. Fair market values of the assets required were land, $80,000, so we can increase our land by $80,000, which is an asset. We can increase our buildings by $400,000. Increase equipment for $200,000. And then we also get to increase our liabilities for $140,000. So our long-term debt is going to increase as well. Now here again, we would have to add up all of our assets and subtract the liabilities to see if these two actually equal, and they don't. If you add up our assets, you would see that we have, let's see, 400 plus 200 plus 80, that's 680,000. But what did we pay for that 680,000? We paid 640 plus debt of 140. If we pay more than the value of the business based on the value in the books, the assets, we have something called goodwill. So our goodwill is also going to increase in this case by $100,000, the difference between those two. And again, let me just check my work, make sure I didn't give you any bad information. Oh, I didn't like those first four. Let's go back and see if we can change that a little bit. What did I do? What did I do? Well, let's see. I'm not quite sure what the problem is here. Maybe these are not in the right order. So let's say land minus 26 and cash increase 22.8. This I can see here, I should have had a patent increase of 136,000 and cash credit. I don't know if I clicked the wrong button there or something. But when you paid for it, we would have credited cash. Is that the problem? Yeah, that was it. Okay. Little fussy, a little temperamental. You guys know that. You've been using the software a lot. So let me know if you have any questions. Thank you.